Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Nela Richardson of ADP Research, noting the positivity in the US jobs market, but saying, quote, the strength of these headline numbers masks sector-level weakness. Nela joins us now for more. Nela, it's good to see you. Let's go back to Friday's data. And before we get to Friday 8:30 a.m. and the payrolls report, I want to talk about you, Mitch, that came out a little bit later. How concerned should the Federal Reserve be about that hotter than expected inflation read in that survey?
In a word, very. I mean, to see a percentage point increase in expectations for the year ahead inflation outlook is concerning. It shows how quickly consumers can change their views of inflation. And remember, expectations are a key input that we don't talk about on inflation and triggering it higher. So I would be very concerned about keeping inflation expectations anchored not at the 4.3%, which is what the Michigan survey said, but at the 2% target. That's where around where consumers anchored their inflation before the pandemic for 2 years leading into the pandemic. Now to see it rise higher after their well-deserved battle to reduce inflation, to see it edge higher is a concern.
At the same time, I got a number of notes just saying ignore. Please disregard. This is a completely political instrument at this point that basically just measures how much Democrats are displeased with the Trump presidency. And Republicans seem to be just fine. Other people pointed out that there was a slight deterioration among Republicans who were polled in the University of Michigan sentiment survey. Do you think it is valid to discount the University of Michigan because of the small sample size and the political leanings that it tends to represent?
What I think is valid is to look at another source, and we're going to get expectations data from the New York Fed that could corroborate this existing. So I don't throw away any data points at this point. I think they're all well worth considering, but not in isolation. So if you have the New York Fed corroborating the UMich survey, then there's some teeth to what we're seeing in that survey.
Going back to the labor market, you said that even though there is a lot of strength, especially with the revisions that we saw that were lower than people expected in terms of removing jobs from last year's tally, do you see something happening specifically in real time that's making you more concerned about the health of the labor market?
Absolutely. And I've said this before. It's a lopsided hiring market right now. You know, there's a lot of strength. So let's step back a little bit to the 3-month averages, both for the ADP numbers and for the BLS numbers. You're seeing private sector hiring over the last 3 months average around 200,000. That is a strong labor market, but it's all basically focused on consumer-facing industries, whether you're looking at leisure and hospitality, so short-term restaurants, hotels, vacations, or longer-term healthcare needs and healthcare industry seeing those gains. What you're not seeing gains in is in manufacturing, in the goods sector, in construction. That's a concern, especially if you're looking at possibly more tariffs in the future. So where are we going to get the hiring in the goods sector? That's what we're watching.
A cause for concern for the Trump administration. We spoke to Kevin Hassett on Friday. He said the benchmark from last year, it was the biggest downward revision since 2009. Was the Biden jobs growth not as good? Is Trump inheriting a worse labor market than many were predicting?
Yes. So January is a special month because all of these numbers get re-benchmarked to something called the quarterly census of employment and wages. And not to bore your listeners with the details of that, but it causes revisions. And this time, as you know, Anne-Marie, it did revise down that benchmark hiring rate from last year, but not as much as the BLS had told us that it would. It is a softer labor market than the first print, but overall, it's still very solid, especially in the fourth quarter. So my contention is still that the labor market is solid. You saw the unemployment rate edge down last month. However, there is pockets of weakness that could, overwhelm the pockets of strength if the consumer proves to be less resilient than it was last year.
When it comes to BLS, everyone is concerned that these numbers are just not accurate. How do you make up for that? What else do you look at? I know obviously you look at ADP, but how else do you get a better picture of where we are right now in the economy?
First of all, I think jobs are important, jobs creation are important. Where the jobs are coming from is so important as well. So one data point, 1 month is not going to tell you the whole story. You have to look at the trend, and you can look at the trend in the BLS or the ADP numbers in the private sector as that the goods sector is weak. That is a consistent trend. You don't have to be a true believer of government data to understand that trend. Also, I look at wages, and you saw an increase in average hourly earnings in January. We still see that stickiness in wages in the ADP number, looking at real paychecks, administrative data. That is a concern for inflation, because if wages are sticky, maybe that's good for the consumer, but only if inflation continues to go down. And wages are one of the firm's highest input prices. So if you're looking at tariffs and higher labor costs, that puts especially small firms kind of behind the wheel going into this labor market.
Double dose of Chairman Powell this week in front of the Senate tomorrow and then the House on Wednesday. If there's some senators listening this morning, some congressmen, I imagine there are, what would your advice be? What should they ask later this week?
Chairman Powell? I think they should ask how Powell is thinking about the labor market in terms of verticals, not just overall, not just the solid hiring that he's seeing, but also how different parts of the economy are working. How is manufacturing producers versus small firms and large firms? We need to get into the nitty-gritty, because that's where policy action is going to take place. The headline looks good. It's underneath the surface where all the questions are.
I'm reluctant to build this up too much. As is often the case, we build it up, big grid on Capitol Hill, what happens? Nothing burger on Capitol Hill across 2 days. By the time we get to day 2, I'm exhausted and don't want to watch the thing anymore.
Have you watched it ever?
The full thing?
Yes.
House and Senate?
Correct.
Yes.
You have?
Yes.
Wow, I'm impressed. There is one question that I actually am very curious about. How much they're modeling immigration into some of their inflation forecasts. How much of a variable some of their parameters are depending on how much immigration is limited or with deportations, because to me a lot of people talk about that as being the bigger potential economic impact than even tariffs.
Nela, it's good to see you, as always. Tobin Marcus of Wolfe Research writing, imposing a schedule of reciprocal tariffs would be much more operationally complex than the across-the-board tariffs Trump imposed on China last week and threatening against Mexico and Canada. Tobin joins us now for more. So Tobin, we should probably start there. Just what is a reciprocal tariff? Do you take the average weighted tariff off one place and basically just level it? Do you go product by product? What do you sense the approach will be from this administration?
So it's a little bit ambiguous whether or not the reciprocity is supposed to apply to the weighted average tariff for the entire country or the tariffs that they apply on U.S. imports in any particular product category. I think for what it's worth, the main legislative proposal on this topic from House Republicans that's been around for a few years, initially co-sponsored by Sean Duffy, who's now in Trump's cabinet, would take the latter approach. It would go product by product. So if that's the case, I think this is going to be something that requires some real elbow grease from USTR and Commerce, rather than being something that you can just implement with the stroke of a pen and have take effect right away. And so my guess would be that what we see this week is an announcement, directives to the agencies to work this out with a subsequently delayed effective date.
Well, Tobin, didn't the president already do that with his memorandum to look at reciprocity when it comes to trading partners by April 1st? What's the difference between that and what he plans to announce this week?
Well, studying it and telling them to actually implement it are somewhat different. There was an indication of interest, you're absolutely right, in his day one memo on America First trade policy. But that memo didn't actually tell the agencies to go ahead and start implementing any of the policies they were looking at, whether it be on that or currency manipulation or anything else. So, at his word, based on how he's talked about it, this could be a directive to actually say, we are doing this. This is now the policy of the United States. And, USTR and Commerce need to come back with the actual implementation details, a month, 2 months down the line.
If he's looking for reciprocity, is this a negotiating tool, potentially giving a grace period for some of these countries to come back and say, let's do a deal?
So, yeah, if it applies globally, or even if not, it certainly is a negotiating tool implicitly, because there's an obvious way to lower the reciprocal tariff rate that you would face if you just lower the rates that you're charging on the U.S. Whether or not that would mean a grace period is less obvious. I think these tariffs, unlike, for example, the 25% across the board on Canada and Mexico, are not necessarily going to be so drastic that I think the administration is going to be all that wary about having a temporary period where they're in effect. So, having this threat out there, having it actually be implemented once they're ready to do that implementation, and then offering countries the prospect of relief if they subsequently bring the rates down, I think is pretty plausible.
Tobin, when you zoom out, there's a real question of why these tariffs are being threatened in the first place. Michael Zezis over at Morgan Stanley, in a note over the weekend, said this, that right now tariffs will remain a tool of U.S. public policy. Simply put, tariffs are a bargaining chip, not a policy goal. Do you agree?
I think there are different kinds of tariff threats and tariff policy goals being contemplated in this administration. And Secretary Bessent, distinguished between these different categories of tariffs in his confirmation hearing a few weeks ago. There was one category that very much is a negotiating chip. I think that's certainly what we saw in the Canada and Mexico case. But they've also talked about tariffs as a revenue source, as redress for unfair trade practices, as sort of a structural force you'd put in place to try and address the trade deficit and protect certain industries in the U.S. So, at some level, any of these things could be bargained off based on some set of both trade and non-trade concessions, but I don't think that's the goal first and foremost in every single case.
Do you have a sense, Tobin, that Trump's administration is trying to get tariffs and some of the more restrictive growth policies out of the way before going to tax cuts and some of the more pro-growth policies?
I don't think they're sequencing that way intentionally, although it certainly is working out that way. I think the sequencing that we're seeing is largely based on what the president has the authority to do quickly versus what he needs congressional cooperation on, which then inevitably moves slower. If he could do tax cuts right away, if he could have done an executive order implementing tax cuts the same way that he has on immigration or tariffs, I think we would have seen that already. But the reality is Congress moves a lot slower than the executive branch, and so we're seeing him move quickly in the areas where he has the authority.
Tobin, we'd love your thoughts on Europe and taxes. We keep hearing from the administration that they're unhappy about how American products are taxed across the continent in the European Union. We heard from Kevin Hassett as well, the director of the National Economic Council, on Friday when he spoke to us about the same thing. American products getting taxed more than we tax, say, European products here within the United States. Tobin, how do you address an issue like that? How are they going to do this?
Yeah, I think the EU has been, in my mind, the most significant target for possible bilateral tariffs other than China. I mean, we've seen those threats, obviously, in the Canada and Mexico case as well, although I've always been inclined to look at those, again, a little bit more as negotiating tactics. But I think the EU, along with China, are the two kind of major trading blocs where I think there are sort of significant, serious grievances about bilateral trade practices and the way the trade relationship looks. And I could absolutely see higher tariffs on a variety of product categories, with autos being one of the most obvious.
Autos definitely being obvious because that gap is so large. But Tobin, when it comes to taxes, for this to be successful for the Trump administration, do they need to get that corporate tax rate down for companies that are willing to produce more in the United States?
I think that getting the corporate rate down to 15%, specifically for domestic production, as President Trump has talked about a lot, I think that's quite likely to happen. I think that's a relatively affordable policy to fit into this tax bill, much more so than some of the things he's been reiterating his support for recently, like the tax exclusions for overtime and Social Security. So I think they probably will manage to get that done. I don't know that it's that critical for competitiveness, just because the base of that's probably going to be fairly narrow, and the U.S. has a variety of other advantages as a sort of target for investment beyond just our tax rates, but certainly that is on the menu.
Hey, Tobin, appreciate your time. Thank you, sir. Smart as always. Tobin Marcus there of Wolfe Research. Let's stick with tariffs. President Trump saying he'll impose 25% levies on steel and aluminum imports from all countries. Francisco Blanch of Bank of America writing, the rationale for the use of tariffs has expanded from a response to an unfair subsidy or advantage to the pursuit of political objectives. Trade war is now the continuation of politics by other means. Francisco joins us now for more. Francisco, that's quite a statement, and a lot of people might agree with you as well. The situation, I'll put it this way, feels fluid. I'm being diplomatic. What does it mean for some parts of the commodity market versus, say, others?
Well, John, thanks for having me again in the program. I'll tell you, it's very confusing. We've seen a big impact on the prices of regional commodity differentials. We saw it last week, prices of Canadian gas versus U.S. gas, Canadian crude oil versus U.S. crude oil. We are seeing it today with the prices of regional aluminum and steel premium and in the U.S. But also we are seeing the effects on the term structure of commodity markets because as these tariffs get applied, you don't know exactly when they're going to be applied. So people are trying to rush the commodity in. So you're getting that if you like, that mini spike up the front, hoping that maybe you can squeeze a little more product in before the tariff hits. So it's impacting really regional differentials. It's impacting the term structure of the price, spot versus forward. And of course, some of these measures are being announced in the morning and taken back in the evening. So we are a little concerned that there might end up being some negative economic effect because of all this uncertainty. But certainly, as I pointed out, I mean, this is really a negotiation tactic, and that's, I think, what the market believes. But also, as you pointed out, some of these tariffs, they get put on and they just stick around for a while.
They stick around for a while, which means what potentially could happen to trade flows? Are you already seeing trade flows around the world start to shift?
Well, the reality of the matter is, in the last trade war we had in 2018-19, we ended up seeing some damage to global PMIs, right? And ultimately, of course, we ended up with COVID in 2020, so everything became very distorted. But we had a pretty strong cyclical backdrop in 17-18 when all this tariff started, when trade war started. So we are a little concerned about the negative effects. Remember, at the end of the day, a tariff is a tax, and when you put a tax, that tax needs to be split between the importer and the clients of the importer, and maybe some of it gets washed out in the FX. But I mean, to give you an example, if you're a U.S. industrial that's buying aluminum, you're gonna have to find a way to pass that through, and most likely that's going to impact your margins as an industrial producer. And America, buys some raw materials, but also produces advanced manufacturing. And now the question is how deep does that supply chain go? Do you have the tariffs just on the aluminum or also on the aluminum product? And remember, last week, some of the most vocal voices against tariffs came from the U.S. refining industry. They said, we buy all this cheap Canadian crude oil, cheap natural gas from Canada, and we turn into amazing products like gasoline and diesel that are, top of the line. And that's one of the reasons the U.S. refining sector is so competitive. The tariffs would have really hurt that, right? So you have to be careful. You never know where things are going to come from, and it's really one of the challenges that we are seeing across the board.
I'm glad you brought up 2018 because that's when the U.S. hit nearly $7 billion of European steel and aluminum exports with duties. This was under Trump's first administration. And then, of course, we had this retaliation from Europe on things like Harley-Davidson motorcycles. What kind of retaliation can we expect this time around?
Well, I think one of the big challenges that Europe has is obviously Europe, to your point, has a trade surplus with the U.S. But there's also a large services deficit on many areas, right? So there's sort of talk about tech potentially being involved as a retaliatory sector. We could see some retaliation, but I think importantly, the European industry is not in great shape. You're looking at very high domestic energy prices as a result of the Russia-Ukraine war. Cutting off supplies of energy, pipeline gas into Europe. You're seeing also weak demand for European products in China, which of course has a domestic demand problem that's fed on into European industry. So I'm not sure Europe is in a great position from an industrial standpoint to cope with rising tariffs from the U.S. So it's a frail moment for Europe. Growth is barely scratching 1%. Germany's been in pretty much recession for 3 years running, and now we're seeing natural gas prices spiking again in the past few days, right? So it's a tough combination. I think Europe is a tough spot. But of course, if the Russia-Ukraine war ends, I think things will ease, right? So that's perhaps the big hope, is that we're going to see the end of the Russia-Ukraine war.
Francisco, that's a muddle of uncertainty. What's your highest conviction amid a muddle of uncertainty at a time where one of these tariffs, if they go through, could be inflationary or deflationary if it really suppresses growth?
Well, so for us, one clear winning area has been the precious metals complex. So we've been very bullish on gold and silver. We have a $3,000 target for gold, which today we scratched 2,900. Silver, we believe it goes $35 an ounce. And so we see that as a winning area within the commodity space. Continued diversification from central banks, but also investor portfolios. Oil, a little more range bound. Difficult to call here between this barrage of tariffs, but also sanctions, right? Sanctions on Russian energy on the way out by Secretary Yellen, and then there is the discussion around Iran. What happens to Iran? So to us, the cyclical commodity complex is really on the edge with PMIs around 50. And so the clear trends are, like I said, in the precious metals and perhaps in some of the softs and the meats. The grains market also complicated to call here with forecasts shifting quickly and suddenly adding to upside pressures on a market that was on a downward trend for a while.
Francisco, can we finish on energy? I think we're used to, historically, people like me at least, being long the whole complex at the same time. Within energy, you're starting to notice dispersion, reasons to be bullish some parts and bearish others.
Right. No, we do, and certainly, I think we've been more bearish crude oil this year. It hasn't played out that way. I think the tariffs on Russia the sanctions on Russia were quite unexpected. They distorted some of the volumes and therefore created tightness in the market that probably reduced the surplus that we were projecting. So now we're more neutral. We think oil is going to be averaging, Brent's going to be averaging 75 and 71, 72 for WTI. So we see a more range-bound market. But yeah, the energy complex is vulnerable to cyclical demand conditions, and it's also, frankly, vulnerable to OPEC restarting or bringing production back in April, right? So we'll see if OPEC does that. But at the same time, you got other factors, like I mentioned, on Russia sanctions and potentially Iran maximum pressure, which is in shelf for now, but could come back, right? So energy is a little more complex. There is plenty of spare capacity, so people are not truly worried. But at the same time, there's low inventories, and that keeps the market in a range, in that kind of $70, $80 range environment with the curve in backwardation. So that's the backdrop in energy. Natural gas more complicated. We see strong demand for power, driving gas in the U.S., in Europe, elsewhere, and we have a tight market for power. So it's electrons versus molecules here.
A lot of competing forces, that's for sure. Francisco, appreciate your time, sir. Thank you. Francisco Blanch there of Bank of America. Erin Browne of PIMCO writing the following. Recent macro data and earnings reports indicate a US economy that continues to outpace other developed markets. We maintain an equity overweight concentrated in the United States. Erin joins us now for more. Erin, welcome to the programme. Let's start with that. And let's start more broadly as well with just some of the consensus positions coming into 25. We've upended a series of them. US versus Europe, for the dollar bulls, for the bond bears. There's been plenty to think about. Do you think they're just position squeezing or something else, something more?
I do. I mean, I think that, coming into this year, the markets were, broadly speaking, pretty long dollar, short bonds, and long equities, but long probably U.S. equities over the rest of the world. And really none of those trades have panned out. Europe has outperformed the U.S. Bonds have basically gone nowhere. And similarly with the dollar. I think a lot of that is just a little bit of position squeezes going into what was, fairly crowded positioning in the beginning of the year. But when you step back, I see very little reason for the rest of the world to outperform the U.S., particularly under the Trump administration's policies that they're pursuing. But also, if you just look at growth dynamics and inflation dynamics across the world, the U.S. is clearly continuing to outpace and outperform the rest of the world, which, really would give way to the U.S. equity market outperforming the rest of the world as well. And, while certainly the Fed has paused relative to other central banks, what you're seeing now is probably more fiscal out of the U.S., which ultimately is what is going to drive the economy more so than central bank rate cuts at this point, at this point of where we are. So I think that the U.S. is still, front and center, the main outperformer within U.S. equity markets. And I think that U.S. domestics particularly are what's going to outperform this year.
So Mislav Matejka over at JP Morgan in Europe, Erin, made a similar point, that for this trade to work the way it has been working over the past few weeks, you need to close growth differentials, and there's no sign of that happening just yet, which takes us back to the US and your call. So let's sit on the US equity market and think about what's working, banks, what's not, certain parts of tech. What do you think will work in the year ahead and why?
So I think staying as domestic as possible is going to work. So financials, I think, are going to continue to be an outperformer this year. Also, the power utility names, particularly those that are leveraged to the AI trade, I think those names still work. Clearly, they took a little bit of a breather in the beginning of the year and late last year, but I think that position is actually really attractive to re-enter right now. I also think that some U.S. cyclicals, consumer cyclicals, will work, but I really stay away from any cyclicals that have international exposure. Energy sector, I also think, is going to do quite well this year. What won't work? Industrials continue to forestall any type of CapEx investment. They've now pushed it out another 2 quarters to the end of this year. Business CapEx is underperforming relative to, or business sentiment rather, is underperforming relative to consumer sentiment. And so I think that, what anything with international exposure that is going to be front and center with respect to tariffs is likely going to underperform. And some of the more deep cyclical materials, mining, industrial sectors are likely in that bucket, whereas the ones that are more leveraged to the consumer are likely the ones that are going to outperform this year.
Erin, there's a tension here. If the risk is actually an outperformance in the U.S. economy to people's relative expectations right now, then doesn't that challenge the idea of rates remaining where they are, going significantly lower on the long end, which is almost necessary for some of the more domestically focused smaller companies to do better?
Well, I wouldn't go so far down the line as investing in small caps. I'm not making a call that small caps are going to outperform relative to large caps. I still think large to mid caps are really where you want to invest. That said, rates are still restrictive, absolutely. They've come down, meaningfully since the third quarter of last year, but they're still in restrictive territory. We think that the Fed is likely not done with its rate cutting path in this cycle, so there still are more rate cuts to come, but they've probably been pushed out into the back half of the year and into 2026, and we're likely to see the Fed take a little bit of a breather here and wait to see the impact of, first, the rate tariffs, the rate cuts that have already transpired, and second, the impact of tariffs and some of the other executive orders that you've mentioned. So I think that the Fed right now is in a wait and see mode, but they're not at the end of the rate cutting cycle. There's still more to come. That said, in order for those small caps to really meaningfully outperform, I think you're right. I think we do need to see rates, significantly lower from here. We're likely not going to get that, at least in the first half of this year, which means that the large and the mid caps will likely continue to outperform.
At the same time, the large and the mid caps tend to be most pressured by a strong dollar. I'm just thinking about all of these sort of America First stories and how they trickle out in the different asset classes and how it really rebounds back to corporate fundamentals. How much is that a headwind that's been priced in versus something that still is going to be felt through as we get earnings?
Well, with respect to FX, you're already seeing, fairly significant impacts on the FX side. Some of the consumer staples names, and we still have a number of staples names left to report, but they're seeing headwinds anywhere from 3 to 10% in terms of the FX hit. That's a sector that we're a little bit more cautious on right now because of it. And if you see the impact of tariffs also, having a double, whammy in terms of the hits, that's also going to, hurt, I think, that sector, which is why I think, any of these sectors with significant international exposure are ones that you likely want to stay away from, or companies with significant international exposure are ones that you want to stay away from. The U.S. consumer as a standalone is very strong right now. And if anything, what we're hearing out of some of the consumer companies coming out of the fourth quarter is that they saw strengthening into the fourth quarter, and at the end of the year, at sort of recent cyclical highs in terms of the consumer dynamics and behavior that they're seeing. So, I think ultimately fundamentals trump what you're seeing in some of the noise in Washington. And ultimately, investors are going to go back to fundamentals and go back to what's working. And I think that you've seen, several themes emerge in the last, 3 months or so that are likely going to continue into the rest of 2025.
Erin, appreciate it. Erin Browne there of PIMCO. Bit of a clinic there on Trump 101.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.